on the opportunity side, we're still very excited about performing credit, senior direct lending specifically, and as we move down the capital stack, flexible opportunities like liquidity-based financing, subordinated debt, but things that are bespoke structuring solutions can really be interesting. As we think about the more medium-term opportunity, what we do see today is that on the traded and liquid side, pricing is a little bit too close to par, but over time we expect this to evolve, and this could be an interesting opportunity over the medium term. When we think about risks though, LPs and GPs are laser focused on credit quality today. We're focused on downside protection, tightening of terms, potentially adding things like covenants to the mix, just to handle the uncertainty in the market and just to hit that on its nose. I mean, we're seeing enhanced inflationary pressures, potential rate rises in North America. Europe has increased energy prices, and so there are a lot of different factors to consider. But coming back to the credit quality and the decision making is really key to navigate this time period. And finally, one comment on LP portfolio construction. What we do expect to see is some moderated and prudent optimization of portfolio construction to navigate through the current environment. But what we're not expecting to see is big deviations from strategic planning. ESG could have been considered the word of the year last year in private markets, and that's inclusive of private credit. I mean, really, LPs are driving this, GPs are driving it, and regulators all together, which is really how we can make a difference. The one thing that has changed is that private credit GPs are really starting to take ownership of what they can do in terms of ESG in the market. So we're seeing things like ESG-linked financing facilities. We're starting to see ESG margin ratchets, reporting requirements come up as well, and also within private credit strategies, some commitment to carbon offsetting or overall carbon footprint. And so we really are seeing GPs take note. On the LP side, we haven't seen much decision making to date around ESG specifically, and we think some of this might be driven by the inconsistency of data and the incoherency that provides to LPs. And so what we at Hamilton Lane have done is we've partnered with the Ford Foundation, S&P, the Omidyar Network, and a sophisticated management team to actually launch a public benefit corporation called Navata. And Navata is an organization that really looks to collect and systematize how ESG data is collected so that LPs and decision makers can make decisions off of really high quality data. So we're excited about this contribution and look forward to its impact. So I'll take this in two ways. The first is around direct secondary transactions within individual credits. And so right now, with credits pricing quite close to par, we're not seeing a lot of individual secondary transactions. That being said, this story will evolve over the medium term, and so this could change. When we look at the LP secondary market, which maybe is where you're getting at in your question, there are a lot of tailwinds. Given the absolute fundraise numbers in private credit have continued to grow, we're really excited about the tailwinds in this asset class. That being said, this really is a specialist buy. These portfolios are hard to price and there's limited information. But what they do offer is they can offer nice yield, J-curve mitigation, shorter duration, and blind pool risk mitigation for the LPs. And so we do think it'll be an interesting area in the coming years.